Hi, I'm going to discuss financial planning for ultra high net worth individuals. Generally, the definition is high net worth individuals have $1 million of liquid investable assets, excluding their primary residence and personal assets. Very high net worth individuals have at least 5 million in investable assets, and ultra high net worth individuals have 30 million or more in investable assets. Financial planning includes minimizing taxes, optimizing investments, and creating a robust estate plan. So, for minimizing taxes, one part of that is maximizing your tax deferred accounts. So if you do have earned income, moving that or maximizing contributions to 401ks, individual solo 401ks, it could be IRAs. It might not be a large part of your portfolio, but any bit that can be deferred helps. Tax efficient investments include municipal bonds. So if you're investing in municipal bonds, and that could be individually buying the individual bonds or bond funds, and that can be short, intermediate, long duration, and they can be state specific. They pay interest, but it's tax free. It generally is a lower interest than corporate taxes, but if you're in the 37% tax bracket plus your state taxes on top of that, that difference closed, and it may be an advantage to use municipal bonds. In addition, probably you want individual stocks so that you don't have any turnover in the investment. So if you're using funds, generally exchange traded funds or index funds that have low turnover, they're not doing a lot of buying and selling, so that gains tax. So you want funds that are just holding assets, or you're using individual stocks where you have total control of that turnover. Charitable giving, if you do have some charitable intent, there are some vehicles that can be tax advantaged. I guess it's tax advantages to give charitable contributions, but a donor advised fund could be useful. Let's say you sell a business, you have a large amount of taxes in a certain year. In that year, you can set up a donor advised fund, make a contribution in that year for charitable contributions that you'll make over the next several years. So you get the tax break in the year you fund the DAF, the donor advised fund. You control how it's invested, and then you can distribute it in over as many years as you want. But you get the tax break in that first year when you contribute. You could contribute over multiple years, and you'll get a tax break every time you're contributing to it. But the idea would be as if you have a high tax bracket for a few years, that would be ideal for a donor advised fund, and then distribute it as you need it. There are charitable remainder trusts that you can set up. You're getting the income for life or a set number of years, and then the remainder goes to charity. There are charitable annuities where you make a donation, make a contribution, or set it up. You get a tax break in the year you set it up. You get a stream of income for your life. It could be delayed when it starts, but you'll get a stream of income for life, and then the remainder goes to charity. Those are ways to get some additional, I guess, tax break in a certain year. Gifting is a good vehicle. The limits or the exclusion is $19,000 per person per year. In 2025, it increases each year. If you have a spouse and multiple people you're giving to, each spouse could give $19,000 to each recipient. So you could be giving $19,000. One spouse could give $19,000 to each kid, $19,000 to each spouse of the kid, $19,000 to the grandkids, and then the other spouse could do the same. So that's a good annual way. It doesn't go against your estate tax limit. You give appreciated stock. You can, yeah. In addition to gifting appreciated assets, irrevocable trust, Dynasty Trusts, irrevocable life insurance trusts, that can provide tax benefits and preserve your family wealth for future generations. Roth conversions, if you're anticipating that you'll have higher tax situation in the future, maybe when you start your required minimum distribution at 73 or 75, then you could fill up some lower tax brackets from converting some IRA money into Roths. You'll incur that tax hit in the year you convert, but it'll move money into a tax-free investment account and reduce the amount you'll have to take out later from your required distributions. Investment strategies, a lot of times we're using individual stocks rather than a fund. It allows you to tax harvest the tax losses. You can go through asset by asset, sell underperforming stocks, get into another investment, take that capital loss, or offset some capital gains. You can defer a lot of your capital gains. You just have more control of your tax, of your account. So for ultra high net worth individuals, diversification can go beyond just your typical stock bond index mix. You can get into private equities, real estate, hedge funds, commodities. Global diversification makes sense. You want exposure to US, of course, but developed and emerging foreign. Depending on the size and complexity of your situation, you may want to hire a family office. We provide services to ultra high net worth individuals, but to multiple families. If you have extra complexity and you want to hire dedicated staff, that is an option. Risk management and hedging strategies become important. That can include put options or covered calls, where you're just trying to generate some more income without incurring the capital gains. So estate planning is very important. We're looking at Dynasty Trusts could be an option. It protects assets for several future generations. You could have a grantor retained annuity trust, which allows you to transfer appreciated assets to heirs at a lower gift tax cost. So the grantor receives the annuity payments from the trust for a set period. The remaining assets go to the beneficiaries. There's irrevocable life insurance trusts, popular because it allows life insurance proceeds to be excluded from the taxable estate by transferring it to the irrevocable life insurance trust. There's generation skipping, transfer tax planning, and business succession planning. If there is a business that is an asset needs to be dealt with, you want a smooth transition of ownership, whether it's going to family members or employees or an outside party. It's a consideration. Philanthropy and legacy planning. So there can be setting up a private foundation. It would allow ultra worth individuals to maintain control over their charitable contributions and distributions. The foundations are subject to specific tax regulations, but they're flexible, managing donations and grant making. So socially responsible and impact investing is another area, if so inclined. It generally consists of screening, negative and positive screening, including or excluding industries in your portfolio. Thematic investing, shareholder advocacy, engaging with companies on issues around the environment, diversity of boards, labor rights, supply chain conditions, political contributions, and community investing, where you are earning an interest, but you're supporting organizations that might not otherwise have access to capital. Green bonds or impact bonds is another part of the sustainable, responsible impact investing. And you can with companies as an impact investor, focusing on areas such as affordable housing, clean energy, education, healthcare, sustainable agriculture. Again, We're AIO Financial fee-only financial advisors. We're unbiased, don't receive commissions, and don't sell any products. Feel free to set up a meeting if you'd like to talk about this more. You can find out information about us at aiofinancial.com. Thanks for listening.